Let me be clear from the start. This isn't a story about manifesting wealth or a secret hack you can find in a late-night internet scroll. This is not about positive thinking. This is about the day that the algorithms that govern our modern lives decided I was a ghost, a financial phantom. The day my credit score ceased to be a mere number on a screen and transformed into a verdict, a permanent stamp on my forehead that everyone in the system could see but me. That verdict was declined. Not for a luxury car or a platinum card. I was declined for a municipal utility deposit, to turn the water back on. That was my rock bottom. If you've ever felt the cold, impersonal shame of a financial system that has quietly, efficiently written you off, if you've ever hidden from your own mailbox, sit down. This is for us. My descent wasn't cinematic. It wasn't a single explosive tragedy. It was a slow, suffocating avalanche of what I call the perfect storm of the ordinary. I had a small, successful consultancy. I was married. We had a modest home. The numbers on paper worked. Then, my wife began experiencing debilitating fatigue and pain. After a year of specialists, a renowned doctor delivered a devastating, confident diagnosis: a severe, degenerative autoimmune disease. The treatment protocol was immediate, aggressive, and astronomically expensive. We liquidated savings. We redirected all cash flow. We maxed out our good credit cards to cover the $1,500 a month medication copays and the out-of-network specialist fees. We were fighting a war, and credit was our only available weapon. 2 years into this battle, a strange thing happened. New tests, prompted by a skeptical second opinion doctor, revealed the original diagnosis was a catastrophic error. A lab marker had been misinterpreted. The actual condition was serious but manageable with a common, inexpensive generic drug. The relief was oceanic, followed immediately by a tsunami of a different kind: financial ruin. We were not just at zero. We were deep in the negative. The disease was gone, but the financial malignancy it had created was terminal. The $85,000 in high-interest credit card debt, accumulated for a fight we didn't need to have, was very, very real. The medical bills, now disputed and chaotic, were sent to collections as we fought with the hospital and insurance. Our pristine credit, the tool we had wielded to survive, was shattered. And because my business cash flow had been sacrificed, clients drifted away. The dominoes fell with a silent, terrifying rhythm. The emotional landscape of this place is one they don't put in personal finance blogs. It's not simple stress. It's a specific corrosive compound of shame, paralysis, and a profound sense of unreality. You look at your life, your skills, your experiences, your relationships, and you know intrinsically your worth. But the system broadcasts a different value, and it does so with the cold authority of a supercomputer. I began to see myself through its lens: unreliable, broken, a bad bet. The shame wasn't about facing a person. It was about facing a machine. I'd delay opening bills, not out of negligence, but out of a physical dread. Conversations with my wife about the future would just stop. They'd hit an invisible wall of "after we fix this," a this that felt permanent. The most humiliating moment came at a family gathering. My brother-in-law, a good man, was excitedly refinancing his mortgage for a better rate. "You should look into it," he said, clapping me on the back. "The equity in your place must be great." I just nodded, my stomach a knot of ice. I couldn't tell him that our equity was an inaccessible fortress because our credit score was a smoldering ruin at its gates. I felt like an imposter in my own life. That's the core of the trauma. A low credit score in today's world is not just about borrowing money. It is a financial social credit score that dictates your operational reality. It is the background check for renting an apartment where you are competing against dozens of other applicants, and the algorithm filters you out before a human ever sees your name. It is the factor that determines your auto insurance premium, literally pricing risk into your monthly existence. For some professions, it is a gateway for employment, a bizarre logic that suggests past financial distress predicts future dishonesty. It determines whether you pay a $500 deposit for electricity or a $50 one. It is a tax on misfortune, levied silently at every turn. The system ceases to see you as a person with a story and sees you only as a statistical probability of failure. You are dehumanized by data. The turning point for me was not a moment of inspiration. It was a moment of cold, furious clarity. It was a Tuesday. Another declined letter, this time for a basic store credit card I'd applied for in a desperate, misguided attempt to start rebuilding. The reason stated serious delinquency. I sat at my kitchen table, the silence of the house pressing in. The anger wasn't at the creditors or the doctors or even at myself anymore. The anger was at my own surrender. I had accepted the verdict. I had internalized the ghost status. I looked at that letter not as a rejection, but as a diagnostic report. It was evidence of a sickness, and I was the only one who could treat it. The system had pronounced me dead, financially. Fine. But only I could sign the permission slip for a resurrection. That permission didn't come from hope. It came from a decision to treat my financial life like a patient on the table, to perform the autopsy, no matter how grim, and then begin the meticulous, unglamorous work of reconstruction. The first step out of rock bottom isn't a step up. It's the decision to stop digging, to lay down the shovel of denial and panic, and to pick up the scalpel of brutal, factual analysis. The climb begins only after you have fully mapped the depth of the hole. Before you can rebuild, you must conduct a full and unflinching assessment of the wreckage. This is not a task for the faint of heart, and it requires a specific mindset. You must transition from a state of emotional panic to one of detached clinical precision. Think of yourself not as a victim standing in the ruins of your home, but as a forensic investigator arriving at the scene. Your feelings, the shame, the fear, the anger, are contaminants. They cloud judgment. For this phase, you must lock them away. Your only tools are objectivity and a relentless focus on fact. This chapter is the autopsy. It will be uncomfortable. It will be arduous. It is absolutely necessary. You cannot chart a course to a new destination if you refuse to acknowledge your true starting coordinates, no matter how bleak they may appear. The foundation of this entire process is your credit report, not your credit score, which is merely a volatile, algorithmic interpretation of the report, but the report itself, the raw data. There is only one sanctioned source to obtain your full federally mandated reports without cost, annualcreditreport.com. This is the official site created by the 3 national credit reporting agencies, Equifax, Experian, and TransUnion, as dictated by the Fair Credit Reporting Act. You must obtain all 3. Do not rely on third-party services or monthly monitoring sites for this initial foundational step. This is your primary evidence. It is critical to understand that these 3 agencies are not a monolithic entity. They are 3 separate, competing corporations, each with its own databases, sources of information, and potential for error. They do not reliably share information with each other. An account may be reporting accurately on your TransUnion file, but be entirely missing from your Experian file, or vice versa. Think of them not as authoritative judges, but as 3 different biographers attempting to write the story of your financial life, each with incomplete and occasionally erroneous sources. As you review these documents, you will encounter the formal language of financial distress. It is essential to decode this language not as dry financial terminology, but as specific diagnosable wounds on your financial profile. A collection account is not simply a debt you owe. It is a major wound. It represents a primary creditor, the original company you owed, giving up on the receivable and selling it, often for pennies on the dollar, to a third-party collection agency. Its presence shouts to future lenders that you failed to uphold the original contractual agreement to such a degree that your account was deemed unmanageable and written off. A charge-off is a related but distinct injury. This is when the original creditor formally declares the debt a loss on their accounting books. The debt may still be owed, but it is categorized as uncollectible. It is a stark, negative mark that remains for 7 years from the date of the first delinquency that led to the charge-off. More severe entries include public records, judgments, which are court rulings that you owe a debt, and tax liens, which are claims by a government entity against your property for unpaid taxes. These are not just wounds. They are deep structural damages to your financial foundation. They signal a breakdown so severe that legal intervention was required. Each of these items carries a date of first delinquency or similar effective date. This date is the anchor point for the 7-year reporting clock mandated by the FCRA. Your first task in the autopsy is to identify each negative entry, list it, and note this critical date. This is your timeline of injury. Armed with this comprehensive list, you now move to your first active strategy, the formal dispute. This process is widely misunderstood. It is not a magic eraser for legitimate, accurate debts. That is a fantasy promoted by unethical credit repair schemes. Instead, it is a fundamental right granted to you under the Fair Credit Reporting Act. The law is explicit. The information in your credit report must be fair, accurate, and verifiable. The burden of proof lies with the credit reporting agency and the entity furnishing the data. The dispute process is the mechanism to enforce this right. You are not begging for mercy. You are demanding procedural and factual rigor. The strategy is systematic. You are not disputing the validity of the debt itself at this stage. That is a separate process with the collector. You are challenging the credit reporting agency's specific reporting of the item. Is the account number precisely correct? Is the balance accurate to the penny? Is the date of first delinquency correct? Is the status, charged off, collections, reported consistently across all 3 bureaus? Even a minor discrepancy in a date or a transposed digit in an account number constitutes a reporting inaccuracy. You initiate this by submitting a dispute in writing, always via certified mail with a return receipt, to the credit bureau reporting the item. You state clearly which item is disputed and the specific nature of the inaccuracy. The Bureau then has 30 days by law to conduct a reasonable investigation by contacting the furnisher, the creditor, or collector. If the furnisher cannot or does not verify the information within that time frame, the Bureau must delete the entry from your report. This process leverages the often sloppy record-keeping of collection agencies and the automated, high-volume systems of the bureaus themselves. It is a matter of forcing the machinery to prove its own data. Many negative items, particularly older ones sold through multiple collectors, vanish not because the debt wasn't real, but because its paper trail within the vast automated credit reporting system has decayed and cannot be instantly verified under the legal deadline. Concurrently with this broad dispute process, you must begin the clinical task of prioritizing the bleeders. Not all negative items are equally damaging. The scoring models, particularly FICO and Vantage Score, place heavy emphasis on recency and severity. A 90-day late payment reported last month is a catastrophic, hemorrhaging wound. It signals you are currently in active, severe financial distress. A credit card charged off 4 years ago is a significant but older scar. It still hurts your score, but its acute impact has diminished. Therefore, your strategic focus must first be on stopping any active bleeding. This means ensuring all current accounts, any credit card, loan, or line of credit that is still open and in your name, are brought current immediately. Every future payment must be on time, without exception. This is non-negotiable. There is no sophisticated strategy that can overcome the weight of a continuing pattern of late payments. The autopsy, therefore, yields a 2-pronged action plan. First, surgically challenge the accuracy of every past negative item through formal disputes. And second, apply absolute, immediate pressure to stop any present-day financial bleeding by securing the timely payment of all current obligations. This dual approach forms the essential bridge between understanding your catastrophic failure and beginning the deliberate, granular work of reconstruction. The most critical phase of rebuilding is not the one filled with dramatic gestures or complex financial maneuvers. It is the quiet, undramatic period where you execute a series of deliberate, foundational actions. This work is not performed for an audience. There is no applause, no immediate gratification, and certainly no rapid increase in your credit score. While the external financial world continues to view you through the lens of your past, you are engaged in a clandestine operation. You are laying a new foundation, brick by invisible brick, in the dark. This phase is about constructing psychological and procedural armor that will protect the new structure you are building from the very vulnerabilities that caused the previous collapse. It demands a shift from reacting to circumstances to imposing a system of discipline. The first and most non-negotiable brick in this foundation is the creation of a minimal emergency fund. I deliberately do not call this a rainy day fund. That term is too gentle, too reminiscent of a minor inconvenience. What you are building is a financial buffer, or, more pointedly, a psychological shield. Its purpose is singular: to absorb the shock of an unexpected, necessary expense without triggering a relapse into destructive credit behavior. Before you allocate every spare dollar to paying down old debt, you must sequester a small amount of capital. The target is modest but sacred: $500 to $1,000. This money is not for investment, not for discretionary spending, and absolutely not for debt repayment. It is held in a separate checking or savings account, ideally at a different institution than your primary bank, to create a small barrier to impulsive access. Its existence serves a profound psychological function. When an inevitable setback occurs, a minor car repair, a dental copay, a broken appliance, you no longer face the soul-crushing dilemma of choosing which bill not to pay, or, worse, resorting to a predatory payday loan or a desperate credit card charge. You have a designated tool for the problem. This fund breaks the catastrophic chain reaction where one small problem spirals into a new financial crisis. It is the embodiment of the principle that you must fund your comeback, not debt it. With this buffer in place, you now turn to the most powerful and misunderstood tool for deliberate credit rehabilitation: the secured credit card. It is essential to reframe your understanding of this instrument. A secured card is not a mark of shame or a product for the financially inept. It is a surgical prosthetic. When your natural creditworthiness has been amputated, this tool allows you to demonstrate capability with minimal risk to the issuing bank. You provide a cash deposit, typically $200, which becomes your credit line. The bank faces no risk. If you default, they simply keep your deposit. This safety for them is your opportunity. The strategy for its use must be mechanistic and devoid of emotion. You will not use this card for everyday spending or budgetary support. You will select one small, recurring, budgeted monthly subscription: a streaming service, a cloud storage plan, an online newspaper subscription, an expense under $15 that you already pay reliably. You will set this single charge to autopay on the secured card. Then, you will set up automatic full payment from your checking account to pay the secured card balance in full every month before the due date. You will then physically store the card in a safe, difficult-to-access location. You are not using credit. You are programming a closed loop. A tiny, predictable financial event occurs on the card, and it is automatically resolved with your own capital. To the credit bureaus, this broadcasts a new, consistent, and positive data point. Your name receives a statement and pays as agreed every month. You are teaching the algorithm a new, boring, and reliable rhythm. The goal is to cultivate an impeccable payment history on this account for a minimum of 6 to 12 months before any other action. A more advanced and ethically sensitive foundational tactic is becoming an authorized user on the credit card account of a trusted individual. This is not a decision to be made lightly or discussed casually. The mechanics are simple. The primary account holder adds you to their long-standing, high-limit, and, this is absolutely critical, immaculately managed credit card account. Their entire payment history and credit limit are then reflected on your credit report. The potential benefit can be significant as it grafts the positive history of another's financial behavior onto your profile. However, the risks and ethical considerations are profound. You are asking someone to link their financial reputation to your recovery. Any misstep on your part, such as requesting and misusing the card, could damage that relationship irrevocably. Furthermore, any negative activity on the primary account holder's part, a late payment, a spike in utilization, would injure your score as well. This strategy should only be considered with a spouse, a parent, or an individual with an unshakable trust foundation. The primary account holder must understand that they should not physically give you the card or the account information. You are not seeking access to their capital. You are seeking a temporary graft of their credit history. It is a financial organ transplant requiring absolute compatibility and sterile procedural trust. Underpinning all these tactical moves is a required shift in mindset. The philosopher Nassim Nicholas Taleb introduced the concept of anti-fragility, where something fragile breaks under stress, something robust withstands it, and something anti-fragile actually improves and grows stronger when exposed to volatility, shock, and disorder. Your financial life was fragile. The goal now is to engineer anti-fragility. Every automated on-time payment from your secured card is not merely a positive data entry. It is a cognitive reinforcement of a new identity. It is behavioral conditioning for discipline. The emergency fund is not just money. It is a structural component that makes the entire system more resilient to shocks. The process of meticulously reviewing reports and executing disputes cultivates a sense of agency and mastery over a system that once felt oppressively external. You are constructing a financial psychology that does not merely seek to return to a pre-crisis normal, but to build a new normal that is inherently more resilient, more systematic, and more consciously managed than anything that existed before. The silent work of this foundation is the internal reprogramming required to ensure that when credit becomes available again, you are a different person, one who uses systems, not one who is used by impulses. Having established a secure behavioral and psychological foundation, the process of credit rehabilitation transitions from a defensive posture to one of proactive, strategic engineering. This phase is characterized by the deliberate introduction of controlled complexity into your credit profile. The objective is no longer merely to stop the bleeding or to broadcast simple reliability, but to demonstrate to credit scoring models a sophisticated and mature mastery of different types of credit obligations over time. This is a meticulous, patient campaign where time itself becomes a powerful ally, but only when coupled with precise, informed action. The first strategic layer to introduce is credit mix. While payment history is the most influential factor in credit scoring, accounting for approximately 35% of your FICO score, credit mix contributes about 10%. This is not a negligible amount. In the nuanced game of score optimization, it represents a significant lever. Scoring models favor consumers who can demonstrate responsible management of both revolving credit, e.g. credit cards, lines of credit, and installment credit, e.g. auto loans, mortgages, personal loans with fixed payments. If your profile consists solely of revolving accounts, even if managed perfectly, it presents an incomplete financial picture. Therefore, after a minimum of 6 to 12 months of impeccable management of your secured credit card, you should consider strategically adding a small installment loan. The purpose of this loan is not to finance a purchase, but to serve as a tool for credit building. The most effective and low-risk vehicle for this is a credit builder loan. Financial technology companies and many community credit unions now offer these products explicitly designed for this purpose. The structure is counterintuitive, but elegant. You do not receive the loan proceeds up front. Instead, you make fixed monthly payments into a secured savings account or certificate of deposit held by the lender. At the end of the loan term, typically 12 to 24 months, you receive the accumulated principal minus minimal interest or fees. Each on-time payment is reported to all 3 credit bureaus as positive payment history on an installment account. This accomplishes 2 goals simultaneously. It diversifies your credit mix, and it forces the systematic savings of a small sum. It signals to the algorithms, this consumer can successfully manage a fixed payment schedule for a term obligation. It is a demonstration of financial discipline in a new dimension. Concurrently, you must refine your management of revolving credit through a nuanced understanding of credit utilization. This ratio, the amount of credit you are using compared to your total available limits, is the second most influential factor in your score, accounting for 30%. A pervasive and simplistic myth advises keeping utilization below 30%. For optimal scoring, this advice is dangerously insufficient. The most competitive profiles exhibit minimal utilization. The ideal strategy is often termed ASIO, all zero except one. This involves ensuring that on the statement closing date for each of your credit cards, the balance reported to the bureaus is $0. On one card only, ideally the one with the highest limit or longest history, you allow a small nominal balance to post, ideally between 1% and 3% of its credit limit. A balance of $10 to $30 on a card with a $1,000 limit is optimal. This requires active management. You must learn your statement closing dates for each account, distinct from the payment due date, and pay down balances before that date. This practice debunks the misconception that you must carry a balance to build credit. You do not. The scoring models simply need to see that you are using your credit, not how much interest you are paying. ASIO demonstrates active, controlled use while maximizing your score. A more complex and delicate strategic frontier involves addressing unresolved collection accounts through settlement negotiations. If a legitimate debt remains on your report and the statute of limitations for litigation in your state has not expired, the creditor or collector retains the legal right to pursue you. Leaving such an account unresolved presents an ongoing risk. The goal of negotiation is to achieve a settlement in full for less than the full balance, documented in writing, and to understand the reporting consequences. You must first, in writing, request debt validation from the collector to ensure they have the legal right to collect. Once validated, you can negotiate. It is critical to have all settlement terms, the agreed upon amount, the payment timeline, and crucially, how the account will be reported upon payment, confirmed in writing before sending any payment. The ideal outcome is a pay-for-delete agreement, where the collector agrees to remove the collection entry entirely from your credit report upon receipt of the settled amount. It is vital to understand that creditors are not legally obligated to agree to this. The Fair Credit Reporting Act only requires that reported information be accurate. However, many collection agencies, particularly for older debts, will agree to deletion as an incentive for payment, as it is within their operational discretion. You must be prepared for them to refuse, in which case the account will be updated to paid in full for less than the full balance or settled, which is better for your profile than an unpaid collection, but still a negative mark. Finally, you must cultivate strategic patience through an understanding of time-based healing. The negative impact of most derogatory items, late payments, collections, charge-offs, diminishes as they age. Hard inquiries, which occur when you apply for new credit, affect your score for only 12 months, though they remain on your report for 2. Most public records and collection accounts adhere to a 7-year reporting period from the date of first delinquency. As these items approach the end of their reporting life cycle, their drag on your score lessens considerably. Therefore, a core component of strategic ascent is disciplined inaction in one critical area, refraining from applying for unnecessary new credit. Each hard inquiry can cause a small, temporary score drop. During this rebuilding phase, your applications should be highly selective and purposeful, such as for the initial secured card or a credit builder loan, and spaced at least 6 months apart. You are allowing the positive payment history you are now generating to compound and the stains of the past to fade. You are not passively waiting. You are actively constructing a new, positive history, while the old one is systematically archived by the passage of time. This is the essence of the ascent, a calibrated, patient process of adding positive complexity, managing microscopic financial behaviors, and leveraging time itself as a constructive force in your financial reconstruction. The score rebounds. This is the moment you have worked toward with meticulous discipline. The 3-digit number climbs past 670, then 700, and perhaps even into the territory once thought permanently inaccessible. With this ascent comes a new and profoundly dangerous phenomenon: the influx of offers. Pre-approved platinum cards, personal loan invitations with enticing promotional rates, and increased credit limits appear in your mailbox and inbox. This phase is not the end of the journey. It is its most critical test. The financial system, which once cast you out, now perceives you as a profitable participant once more. Its seduction is sophisticated and relentless. Your psychological conditioning, forged in deprivation and discipline, is now pitted against a powerful, data-driven marketing apparatus designed to lure you back into the cycle of leveraged consumption. This is where the true purpose of the rebuild is validated. Not to regain access to credit, but to forge a relationship with it defined by sovereignty, not submission. We now transition from building a score to building a fortress. The primary challenge is the psychology of re-good credit. There is a powerful, subconscious impulse to view the regained score as a reward, a return to normalcy that justifies relaxing the stringent disciplines that created it. This is a catastrophic error. It confuses the tool with the goal. The credit offers are not accolades, they are stress tests of your new financial identity. The system's economic model thrives on consumers who carry balances and pay interest. Your hard-won 750 FICO score makes you a prime candidate for this profitable role. Your objective must be the opposite, to become the most boring, unprofitable customer on their books. One who uses their infrastructure for convenience and security, never for costly leverage. This requires conscious vigilance against lifestyle inflation funded by newly available credit. The emergency fund must grow, not shrink. The practice of paying statement balances in full must remain sacrosanct. The score is a key that opens doors. The wealth you accumulate while walking through them is what grants true freedom. With a stabilized score, you can now integrate more advanced tools for optimization and security. Services like Experian Boost can allow you to add positive payment history for utility and telecom bills to your Experian credit file, potentially providing a minor score lift. If you are a renter, services like Rental Karma or Rent Track can report your on-time rent payments to the credit bureaus, transforming a major monthly expense into a credit-building asset. You should also methodically request credit limit increases on your existing revolving accounts. Many issuers allow you to request a soft pull increase, which does not generate a hard inquiry. Successfully increasing your limits while maintaining low balances further improves your utilization ratio, strengthening your score's foundation. Concurrently, implement advanced fraud alerts and security freezes. You are no longer protecting a damaged profile. You are safeguarding a valuable asset. A security freeze at all three bureaus is the most powerful tool to prevent new account fraud, giving you ultimate control over who can access your credit report. This leads to the fundamental philosophical shift, from credit repair to financial sovereignty. The goal transcends a number. It is the cultivation of optionality. A high credit score is a form of potential energy. It is the ability to qualify for a mortgage at a competitive rate when you choose to buy a home, to secure favorable terms on a business loan should you need to capitalize an opportunity, or to rent an apartment in a competitive market without undue stress. The score itself is inert. The power lies in the combination of that score with the tangible capital, savings, investments, and cash flow you have built alongside it. This combination creates options. You are no longer forced to accept the only financing available. You can choose the best. You are not required to stay in a detrimental situation due to a lack of alternatives. You have the means to pivot. This sovereignty is the ultimate defense against future setbacks. You have moved from being a subject of the credit economy to being a strategic participant within it. In conclusion, this process never truly ends. My own credit score now resides above 800. Yet, I scarcely think about the number. What I am aware of is the profound silence that has replaced the once constant background noise of financial anxiety. The peace of an empty mailbox devoid of collection notices. The calm, automated click of payments processing from an account with a sufficient buffer. The empowerment of being able to decline a predatory financial offer, not out of desperation, but out of discernment. The system did not forgive me. I did not outsmart it in a grand theatrical sense. Instead, I learned its language, its rules, and its incentives with such granularity that I can now operate within its confines on my own terms. I learned to feed the algorithm the consistent, predictable data it craves, while insulating my actual financial life from its inherent pressures. The comeback was never about credit. Credit was the metric, the battlefield. The comeback was about agency, the deliberate, painstaking reclamation of authorship over one's own economic narrative. You are not your credit score. You are not a collection account, a charge-off, or a judgment. You are the programmer. For years, you may have been running code written by circumstance, crisis, or misinformation. Now you possess the knowledge to rewrite that code, line by logical line. The syntax is discipline. The functions are patience, strategy, and ruthless self-honesty. The output is not just a report from a bureau, but a life of significantly greater resilience and choice. The work is quiet, often tedious, and entirely yours. But the silence on the other side, the silence of solved problems and secured foundations, is louder than any approval or disapproval the system could ever render. It is the sound of freedom. That is the destination. This narrative is a single map drawn from one journey. The financial landscape is constantly evolving, with new regulations, reporting nuances, and strategic opportunities emerging. On my YouTube channel, Credit Comeback Stories, we transform these principles into living case studies. We deconstruct real-world credit reports, interview experts on the latest legal and strategic developments, and analyze the complex tactics needed to navigate a system in flux. We provide a community focused not on vague inspiration, but on actionable, advanced financial reconstruction. Your story of recovery deserves to be informed, strategic, and ultimately successful. Subscribe to Credit Comeback Stories today. Activate the notification bell to ensure you receive our detailed analytical content. Your continued comeback, the maintenance of your sovereignty, requires ongoing education. Let us be a resource in that critical, lifelong pursuit. I will see you there.